Hey guys, welcome back to the channel. Today's video, we're going to be tackling some questions that are on a lot of real estate investors' mind. Should you use debt to finance real estate? Now, this is a question that sparks a lot of debates, have a lot of pros and cons about it. This is one personally that we have talked about, my wife and I, about using debt or getting real estate essentially through a mortgage or a second mortgage or a home equity to purchase a second property. And in theory, it sounds great, which again, there are a lot of pros and cons with borrowing money to buy real estate, hoping that the real estate essentially pays for itself over time. Now, before we discuss whether debt is viable for using real estate investments, let's quickly define what debt is. Now, debt refers to borrowing money to get what you want to repay over an amount of time. The problem that we're seeing right now with debt financing for real estate is interest rates are very, very high, guys. If you look totally at interest rates, 30-year interest rates are about 7%, 7.5%, sometimes 8%, depending on the lender. When it comes to debt real estate, debt is really in the form of taking on a mortgage or taking on a second mortgage, like I was saying, on a current property that you have. Now, looking at the potential benefits of a mortgage, you can really leverage a lot of the debt financing. First and foremost, debt allows you to leverage your investment where we don't have cash to pay for a property just outright like a lot of investors. And I know this goes against Dave Ramsey's philosophy of really debt financing, but by using borrowed money to purchase a property, you can increase your borrowing power and acquire more property or a larger property than just the cash you have on hand alone. Now, some people do take money out of 401ks, but the most traditional way of doing this is investment properties. Secondly, when you finance a property with a mortgage, you can benefit from the power of leveraging the property. Now, when you look at the rich and when you look at the wealthy or the ultra wealthy, they do use debt financing for an incredible tool. However, there are a lot of caveats to this, which again, we're going to kind of get into, that are the scary factors that a lot of people do not go into. When you look at, hey, I made $1 million, $100,000, whatever it may be that you make in real estate, there's also an incredible amount of stories and incredible amount of people who have lost a crazy amount of money when it comes to real estate. Now, if the property, and notice it says if the property appreciates over time, you'll experience growth at a full property value, not just the cash you put in. So let's say theoretically you put $300,000 into a property, you buy the property in the course of the next 10 years. Now that $300,000 investment is now worth $500,000, but there are again a lot of caveats that you have to think with that. This potential for increase can be very attractive to investors and real estate investors particularly. Now, the third thing, using debt to buy real estate can provide you with an opportunity to diversify the investment portfolio. So if you have everything in stocks and bonds, if you have it in T-bills, if you have it buried in your backyard, this can really diversify the portfolio by putting a percentage into real estate. Now, what a lot of people do though is real estate is very expensive to get into. Even though you're borrowing money, you still have an obligation to repay that, which means could affect your credit score, could affect a lot of different things. Instead of tying all your funds in a single property, you can allocate your capital to multiple properties, potentially reducing risk and increasing returns. We're just talking about the basics here, guys, having one property. Now, a lot of people do see a lot of, hey, listed on Airbnb, listed on VRBO. Again, is a lot more than just doing that and exactly how simple it is. There's a lot of places that will not allow you to list those properties. There are a lot of associations that will not allow the rental income or the rental property to be used in that manner, so you definitely have to check. Now, some of the risks and concerns, and again, this is where it really takes pause. Of course, with every potential benefit that you see with real estate investing, there are risks and considerations that you have to take into account. So let's take a look at those. Number one being the interest payments. When you use debt financing, you have to make regular interest payments, including principal and interest both. These payments can impact your cash flow, reduce the profitability of your investment, especially if rates are increasing. Now, one thing that I see a lot of people doing is they were taking out variable interest home equities, so interest only home equities or home equity line of credit. Well, now it's great when it's at 3.5%, but then when it goes to 4.5%, 5.5%, 6.5%, now it's at 9%, guys. The investment property that you were getting $1,200 for at 3% was great. You were having a really good margin there. Now that same $1,200 investment property that you're paying on is now at 9%, making your bill $1,800 or $2,000. Now the rent that you're charging for that individual place might not be covering the cash flow that you're getting from it, or it's really squeezing those margins, guys, that you're not seeing the cash flow that you're expected. Number two, the debt servicing. This is the obligation to repay the loan and put pressure on your finances. So we've seen a lot of people with investment properties. You have to have the investment property for multiple years. You have to prove, if you're running it as a business, that it is profitable. If it is not profitable, guys, when you're going to get other loans, let's say you want a mortgage, you need home repairs, you want a new auto loan, chances are your debt to income will be greatly impacted by having two properties now instead of just one mortgage payment. Even though you do have an income coming from that or a steady stream of income, what if nobody is renting the property? What if you cannot find anyone? What if you list it on Airbnb, VRBO, and you're not getting any takers? Or even in the off months where a lot of places are popular around the water during the summer. When it comes to the winter months, just like me here in Michigan, not a lot of rental properties are being rented. When it comes to the summer months, it is a lot more difficult to find someone to book those places, especially if you are waterfront. Now, of course, it's important to ensure you have steady income stream to support this and making sure that you're not going to get foreclosed or you're not going to be late on those payments, because chances are that can affect the rate for any of your borrowing. Now, number 3 looks at market volatility. Now, just like we talked about with the first scenario where you can make an incredible amount of money, there is also a chance that real estate markets are very unpredictable. You could see a downturn in the market like we've seen in 2007, 2008, where that $300,000 property is now worth 120, 150. You cannot get it to sell, or no one is looking to buy it because the market is literally flooded with properties, and most of them are investment properties or they are second homes, things of that nature, where people are buckling down, making sure the primary residence is all taken care of and everything is good. This can potentially lead to financial difficulties if you're heavily leveraged within those markets. Next one we look at is the personal risk tolerance. This is the one that I am pretty stuck with, guys. Everyone's risk is completely different. Some individuals are more comfortable with debt financing. Some are looking to become completely debt-free, which is the case for me. If I'm taking out a second mortgage or another mortgage in its entirety, that to me is another obligation that you're going to have for a multitude of years. Again, depending what you're purchasing or what you're buying it for. If you're looking at a 10-year, 15-year, even another 30-year mortgage, guys, if you have a primary residence that you have a 30-year mortgage, you have a second property that you have a 30-year mortgage, chances are you're going to be carrying that debt for an incredible amount of time. When you look over the course of 30 years, you almost pay for your house twice just in the interest rate, especially with where they are today. It is very expensive to buy investment properties, and they're also being treated differently depending on your financing options when it does come to those properties. Now, in addition, guys, long-term and interest rates, again, as interest rates change, and also the big thing with this is you have to find, if you're looking to liquidate a property, you have to find a buyer, and you have to find a buyer at the right price. In addition to that, you could also have repairs to the property. If there's damage that is not covered by insurance, if it's flooded, if there is updates, upgrades, if there's things that fundamentally need to be done, now you're extrapolating, one property, one house, one maintenance cost into two separate properties. You're literally doubling everything when it comes to a new roof, when it comes to a furnace, when it comes to windows, when it comes to everything. That investment property hopefully has a really high yield and you're making some good money in there, because if you are having to put additional money in there, again, it's going to be kind of a balancing act between both of those. So in conclusion, guys, using debt financing to buy real estate is really a personal preference that you have to take into very, very consideration, guys. Weigh the pros, weigh the cons, really take a look at the market that you're in, the industry that we have. Again, if you're looking at an investment property, which right now they're running 8 to 10%, or investment properties are treated, again, a little bit different on the mortgage side. They are a little bit heavier because of the liability. When it comes to the rate, again, it is a little bit higher. There can also be additional closing costs and things of that nature. So ultimately, stay well informed, assess your risk tolerance, conduct thorough research on the properties you're buying, seek advice from professionals. So if you know anyone who has rental properties, whether it be through, again, VRBO, whether it is through, different method, make sure that you know. Remember, investing in real estate with or without debt requires a lot of planning and a lot of due diligence. All right, guys, so that'll do it for today's video. Let me know in the comments, though, if you do have any investment properties, how they are working that out, how are you listing them, and exactly what the maintenance costs are running in your area. So again, guys, that'll do it for today's video. Let me know in the comments what you guys think, and as always, thank you guys for watching.